Treasury yields, we were just talking about, seeing little change as investors are looking ahead to the Fed's March meeting. Our next guest says that yields are recalibrating for a higher for longer reality, with the market now pricing in less than 3 full rate cuts this year. For more on fixed income, we're going to bring in Truist Fixed Income Managing Director Chip Hughey. Chip, thank you so much for joining us. I know that you were probably overhearing our conversation here with the 2-year Treasury notes yield climbing to its highest level this year. So I want to get your take on that movement that we've seen today. When does that start to bite the broader market?
Yeah, it's great to be with you this afternoon. Thanks. Yeah, I think that what you're seeing is yields recalibrate for 3 primary reasons, right? One, we continue to see sticky inflation data really all year. Last week's PPI was no exception. That feeds into number 2, which means that the Fed is likely now having to be on hold for longer than the market was anticipating, right? And holding rates at these restrictive levels for longer than was expected coming into the year. And we're also contending with really strong Treasury issuance, right? The U.S. government is probably going to issue roughly $2 trillion in new debt this year. That's a lot of supply. But I do think that the biggest factor for yields has been the Fed pricing in 6 to 7 rate cuts for this year coming into 2024. And as you just mentioned in the previous segment, that's down to actually below 3 now. So that's a big change that has real implications on the yield curve.
And Chip, I'm just interested, when do you think, the Fed starts cutting and how deep?
Yeah, I think that the Fed is going to have that sufficient amount of evidence that inflation is cooperating around mid-year. So I think that the Fed has its initial rate cut around the midpoint of this year and ultimately lowers the Fed funds rate 2 additional times, so 3 rate cuts as we progress through the year, ultimately totaling about 3 cuts in 24.
And Chip, just to follow on that, though, you've heard this kind of growing chorus from pretty well-respected economists, Chip, who are thinking there's increasing chance of no cuts. I think of guys like Dr. Ed Yardeni. I think Dr. Ed's base case is still 2 cuts this year, but he did tell clients, Chip, increasing chance here there's no cuts. What do you make of that argument?
I think it's fair that that's an increasing chance. We just don't think that that's what's ultimately going to happen. We do expect inflation to continue to cool. It's going to be a bumpy path, right? We've seen that. And so we think that the Fed, again, will see that inflation is cooling as the year progresses. And if inflation is cooling and yields are, and the Fed funds rate is still at this level, it's becoming increasingly restrictive. So we do think that as inflation carves this bumpy path lower, the Fed will ultimately sort of chase that down a bit lower. But we never subscribed to the idea that the Fed was going to get to 6, 7, rate cuts and start back, as of right now, right? Start this month. That was not what we ever really ascribed to. We felt that the Fed was going to be very patient given the inflationary environment that we've just been through for the past couple of years.
Very patient and definitely still kind of searching for a thesis, it feels like, even though they just say their thesis is that they're data dependent. Having said that, I want to ask you about where our audience of retail investors here on Yahoo Finance should be putting their money if they want to get invested in fixed income. We know that we are at an all-time high of $1.66 trillion in dividends for 2023. For those in our audience who have raked in the benefits of those dividends, where within fixed income should they be playing right now?
Yeah, it's a great question. I think we would emphasize quality. Right now, in the higher quality areas of fixed income, yields remain really productive. Areas like U.S. Treasuries, right? Like TIPS for those investors looking for a little bit of inflation protection. Investment grade municipals. Absolute yield levels are still very productive and very attractive. When you look at the riskier portions of fixed income, credit spreads to us seem a little bit misaligned. They're very low. They're very tight. And we do expect to see spreads widen as the economy slows, as what the Fed has done continues to bite. And what we see in some of the riskier corners of fixed income is fundamentals actually deteriorating, and we've seen instances of default rise. So we think there will be an opportunity to add credit risk into portfolios, but we'll be patient right now and really focus on the higher quality areas I just mentioned.
And Chip, I want to get your take on this. When I look at the yield on the benchmark 10-year, where do you think that actually heads from here, Chip? Do you think we test last year's high?
Yeah, it's a great question. There is a major technical threshold at 435. We are right there, right? 433 today. We're trying to test it. We've tested it maybe 4 or 5 times so far this year. So we're watching that 435 level very carefully. If we do pierce that level, because we have not been able to do that so far this year, it probably sets up a pretty quick move up to about 4.5%. But what we have seen is that there is a lot of international demand from areas like pension funds, annuity providers, also retail investors who seem to be attracted to treasuries at that level. We would see demand step in if we get to that point. So we do think that we set the high watermark in the 10-year back in October when we went briefly above 5%. And we do also think that even if we get these periods of upward moves in yields, we think that we kind of trend lower as we progress through the year, as the economy slows from really resilient readings before, as inflation cools, and again, as the Fed starts to lower rates.
Chip, it was great to have you on the show today. Thanks so much for joining us.
Thanks, Josh. Appreciate it.